Hi, everyone. I thought I'd just run through some interesting stats on some of the stocks I'm looking at the moment. This is taking the global universe, so it includes US and UK stocks, and I've ranked them by the ones which have had some ridiculously high returns over the last 6 months. And the reason for doing this quick broadcast is because obviously I get asked by people and say, do these have something in common? Is there a pattern? And when it comes to looking at stocks, I tend to take a scientific approach, which is I develop a thesis, and the thesis is based, like any theory, on things that performers like these performing stocks might have in common. So if something's up, 3,000% in 6 months, does it have something in common with all of these others which are up? And does it have something which is not in common with the ones which haven't risen, which haven't done well? And if there is that coincidence? Is there some causation? Is there something in the data which supports that hypothesis that there is a causal relationship? And of course, those relationships can change over time. So it might be related to free cash flow. But how important is that? Is it very important or not? Okay. And as I said, the weightings of those things can change. Now, that's the same decision-making process that everybody uses in their lives for making any decision. What factors are important and how important are they? So you've got to decide what's important and give a weight to it. It's also the scientific approach is also, hypothesis, and then looking at data and correlation is also what we use for, finding vaccines. Not that picking stocks is as important as finding vaccines. So I was looking through some of these, and quite frankly, I would not have been able to have picked them in advance. There's a whole bunch out there. There's something crazy like Oasis Petroleum, which I hadn't heard of until this morning. It would be such a speculative play. You'd be holding it for a very long period of time, and then it may or may not pop. And it's got characteristics which also are held by other companies which haven't risen and may never rise. So there isn't a pattern there that's necessarily discernible. Well, is there something with Relief Therapeutics? You might argue the word therapeutics is the factor which is why a company such as that has gone up, 3,700% in 6 months. But again, we've been looking through the data. We've been looking at things which remove the speculative element and provide some degree of consistency of saying, well, if companies meet certain criteria, there is a high probability they will generate an increased return, an outsized return, than there isn't. And that we can do at the returns where it's something like, say, a 40% per annum. It becomes harder the higher the return you're looking for, even if you elongate your time frame and say, I want that return over the space of, say, a year, or over the space of 2 years. So you might say, well, I want 100% return or 1,000% return in 2 years. Of course, we all want a 3,000% return in 6 months. So what I'm trying to do here is explain to you how markets work. And of course, 90% of the time, people end up speculating. They end up guessing. They throw darts into data and they say, oh, I think this is a reason why this one went up, so I'll use the same half-baked idea onto why I'd buy something else. We don't do that. But we are, and we continue our research into looking for, there's one you've heard of. Let's say the next GameStop, which has gone up 1,000%. So let's go through some of these. Now, sometimes it can be as stupid as, well, if we do find their valuation looks good and we find that there's a solid trend and we find they're consistent, like an Argo blockchain, whilst we didn't expect it to shoot up, there are certain patterns here which are more useful and can be copyable, can be scalable and replicated when looking for other similar kinds of stocks which have similar characteristics. Usually what we find is that the kind of companies which will give those kind of outsized returns, say a 2,000% there, will be very different to this petroleum one, which we had no chance of ever guessing or getting hold of, where you'd be holding, like I said, for years. We want to avoid those, even though it's shot up, because we can't separate that from the ones which never go anywhere. So we're looking for the ones which are separatable, which are do have certain characteristics which are consistent with the potential for the upside. But then we've got to consider, how long are we willing to wait? Because it's an opportunity cost of waiting. And not only that, if we are willing to wait for those outsized returns, is it something, like I said, that we can look at? Is it, for instance, the free cash flow conversion. But what if other companies have got a really high free cash flow and have never risen? Then obviously that would hit our thesis that it isn't free cash flow. Or maybe it is, but it is one factor. If it's one factor, then what weight should it be given? What evidence is there that it should be given in an overall weighting of, say, it should just be given a 10% weight? Or, you know, in other words, it's not very important. So this is just to give you a bit of an insight into what our thinking is, because we do have our regular, you know, want to try and generate 40% per annum from your, you know, your Apples, your Microsofts, your Squares, your PayPals, all of that kind of stuff. That's the regular stuff. That's the bread and breakfast. That's the bread and butter. That is the SIP, the ISA kind of stuff. But there is a broader stuff than that. The sort of what I call the strategy 10x, the special department, the R&D department, where their job is to develop hypotheses and then test them against the data to try and capture the outsized returns. Not the ones which would go into a pension or a SIP, but the ones which, even if you had a relatively small amount, because of the kinds of size that they move, you can see the figures there, would be significantly larger and compensate for some of the time. But we want to get those returns in a relatively short space of time because there's the opportunity cost of money. And equally, we don't want ones which, like you can see here, this we will not pick. Our data will not be able, even though it's a great return, for the simple reason it goes nowhere for a very long period of time, then shoots up maybe a takeover bid or whatever else. There's many other companies like that, but they never go anywhere. So we're looking for, like I said, those patterns which are copyable, which are replicable. Okay, and whilst a company with name like with blockchain in the name, you might think it's a pattern because there's a few of those, it's probably going to be closer to something like this, something which already shows some kind of consistency in movement, but also has, so you can see here, and in the case of Marathon, you can see here something which has risen 1,200% in 6 months, gives you ample time to get in. So it doesn't have sort of goes nowhere for ages and then explodes to the upside on some speculative piece of information, but instead generally gives you that smoothness of movement. But that's not the only thing. We need then to say, well, there are many other companies like that. They don't go up 1,000%. What was it about this one? And then we need to drill down to say, well, is it their capital expenditure? Is it how much they're spending on R&D? Nothing apparently. Is it their negative cash flow? Surely not. They're running out of cash and yet they're still rising. Maybe it's one to short. But then again, the free cash flow percentage is incredibly high. What of these numbers and factors is it? And of course, these change over time. So the R&D has to continue. It's not as if there is one standstill magic formula to be used all the time. So I just wanted to give you an insight into what our thinking processes are with these things. And we are more likely to be looking at things which, like I said, have a smoother trend and show on the fundamentals certain characteristics which only companies which tend to go up by significant amounts show, and is not shown in the other sample of companies which go nowhere. Okay, so like I said, it's just like any other scientific experiment. You know, we're using data after all to see, is there something that they have which the others don't necessarily have, and to generate those returns. Again, blockchain nation. Now, Riot Blockchain got mentioned a lot on Clubhouse. And a few people say, oh, you got to look at it. And of course, they were telling me in hindsight once it had already shot up. But again, it's a good example of what we're looking for. We're trying to find ones where there is some stability in the price movement. Then there's a gradual, not explosive growth, a gradual move up, which, were it to continue, will give us a good return. And there's something in the fundamentals which will back that up. And it may well be, as I said, free cash flow conversion. It could be its debt ratios to asset ratios, like the current ratio. That's what we research. That's what we look into. There isn't one holy grail of saying, oh, if you get this magic number, it is always that. It can be different things. But I wanted to give you that insight, because if we don't do it that way, then we end up in the area of speculation, which is guesswork. Oh, I don't know, somebody mentioned it on Clubhouse, so I bought some. That won't do, because it's not scalable, it's not consistent, won't give us the kinds of things we're looking for. Now, you look at, say, something like an SM Energy, okay? Goes from 200, it goes to 400, it goes to 800. Now, that happens over a period of months. So this is not hyper fast trading. This is not, oh my God, you've got to jump in today, it'll be gone by tomorrow. We don't want the kinds where you've only got an opportunity over a day. We don't want the kinds where you've got to hold the capital for months and get no return in the hope there'll be a speculative pop for obvious reasons. It's too speculative. That's not what we would want. So again, an insight into working out what your hypothesis is going to be and what your boundary conditions are suited to your own personality of how you want to invest. Okay, and of course, this is the higher risk end that we're looking at. Again, you see with KR1, a company where there's been ample time to see something forming, but just because a company moves upwards month on month doesn't mean it's going to give you a 10-fold return the way this did. That's not enough to give you that, 900% return in 6 months. We've then got to look at the other factors to see what, and again, to repeat myself, what did it have that others which also go up significantly have, and what does it have which isn't in the ones that don't go up? Because you've got to look at the negative sample. You've got to get what's called the disconfirmation. And in the words of George Soros, it's the people who have an ability to naturally disconfirm information that tend to do the best in society. They don't just look for things which will confirm their pre-existing beliefs. They look for things which will disconfirm what they're saying. And it's just that mindset, that turning that mindset into that view, which can very often help analyze things, and not just in investing. I think investing is a really good way of actually analyzing all decisions in life. Again, you see, now look at that. Look at Zomedica Pharmaceuticals. Look at this. You can see there's certain patterns of similarity, and it's patterns that we look for as you do in any degree of science. It's patterns that we're looking for, and it's not just in the prices, it's not just in the charts. That wouldn't be enough, because like I said, there's many companies which trend upwards and then go nowhere. It's also then taking the quantitative approach, and these are just some of the numbers. We'll be looking at a lot of others which aren't on screen. It's looking those and seeing if there's patterns of what do the winners have that the losers don't. And if you can differentiate the two, then you're onto a thesis which works and something which could be used as well. Okay. Robert's got a question. The corporate ego game makes you mad. Yeah, I mean, what can I say? I run my own firm, so it sort of, I don't think I could work for somebody else. I never have since I was a barrister. So I don't know what to advise somebody who's working for, I mean, I do hear a lot of people, employees, who are absolutely frustrated with idiotic bosses. Charlie Munger, who is the co-founder of Berkshire Hathaway with Warren Buffett, put it this way: he trained as a lawyer and then went into investments with Warren Buffett, and is one of the world's richest men, because he said, I couldn't work with someone, I just needed independence and freedom. And so he left. I wanted it so badly that when I was a student, I was living in an apartment and sharing it with some rats. I don't mean people from the city, I mean rats, physical rats. And I was willing to do that in order to have my independence of being self-employed. So yeah, there's a price to be paid for freedom. When we look at this, again, you can see what I'm talking about. Now, this is leisure, completely bloody different to genomics, but a similar kind of pattern. Not just the price charts, not just the price charts. What we're looking for is a theory that are there patterns in those which shoot up 1,000% that exemplify themselves in those, but not in others. And again, we'll look across not just the pricing, but also against, is it the cash flow? Is it to do with gearing, leverage? And it won't be just one thing for all companies. Some might be because of certain factors, others with others. And what we've got to work out is which factors are important and how important are they? A colleague, actually, not a friend, a colleague said to me, he said, I need to know you're the most, whenever you walk into a room, you feel you're the cleverest person in that room. I don't mean that by ego, and I don't mean that by IQ. What he said is, I need to know, you might not know as much as everyone else in the room, but given the same amount of information, you'll have a better sense of judgment than they will. And that ability to finesse your judgment is critical. Now, for us, how do we finesse our judgment on a particular stock, whatever? It's the ability to know what information is important and how important is it. That's in everything in life. And that's what I love about investing, because it's just another microcosm of life. Whether it's choosing a spouse or whether it's choosing a job or a house, what's important? How important is it? And that's critical also when we're looking for these 1,000% returns. It's just that in the investment field, when I use my judgment, I get compensated royally for it. And that's why I like to use it here than in, I don't know, picking horses. So we're trying to remove, as I said, we're trying to remove that area of speculation, that area where I'm not sure. That must mean then that there's too much space for guesswork. Well, we don't want to do that because we don't want to speculate. Anyway, I just wanted to give that insight into some of the thought processes that we have and why I have them. And hopefully you'll find that useful. So just wanted to say thank you. Another question, Asad, am I big in crypto craze at the moment? Asad, I find it interesting. I mean, I do what I call the FOMO. The MOFO trade is something completely different. The FOMO trade, which is fear of missing out. So yes, I've got some cryptos, not because I think they're going to go to the moon. They might. You hold it for 10 years and that's it. I don't know whether they're going to be the next big thing or they're going to go to zero. I bought some Ripple a few years ago. And just so you don't think I'm some kind of crypto genius claiming in hindsight to be amazing, I've lost 90%, probably 99% of my value in my Ripple holdings. And you might say, well, you bought it too early. Oh, I thought that was the bloody point with this stuff. Anyway, I happen to know that, as you will know, that some of these cryptos are being tested, or the languages are being tested. Now, here's the important thing with crypto. So I'm glad you asked me this. I met that chap. There you go. Met that chap at a talk I was giving at Standard Chartered Bank. And I said to him, is there any correlation between Ripple and XRP, the coin? Ripple, the language, which is bloody useful. And I'll tell you, that is useful. Ripple, Ethereum, they're very useful languages. Blockchain, it's going to be and continues to be huge. And that is genuinely useful. Okay. Distributed ledger technology, useful. Is there any correlation between that and the currency, other than noise and speculation? And the impression I got from his answer is there isn't. So, but make no mistake, noise and speculation can put things at astronomical levels, like Dogecoin, or is it called Doggycoin? God knows, Dogecoin, okay? Dogecoin. And I've got my own on BitClout. If you go under Alpesh Patel, I've got my own coin. And guess what? It's gone up about 100% in 2 days. That's nuts. That doesn't make any sense. Why should my coin go up that much? Well, it's linked to social media and the price of Bitcoin. It's crazy. BitClout, it's on there. I'm not suggesting, this is not an invitation to purchase my coin, but I just thought it'd be funny because Elon Musk is always talking about himself. Anyway, so that's a long answer to a short, simple question on that. Listen, thanks everyone. I only wanted to keep it really short for everyone, so I just want to thank you all. And have a visit of alpeshpatel.com. We've got a whole load of free resources on there, including my Telegram channel, where I put stuff when I see interesting things. You'll see the link on alpeshpatel.com if you go there.